Good afternoon, members and the general public. You are welcome to our virtual public lecture this afternoon on the theme, Managing the Tax Environment for Sustainable Business Growth, a toolkit for 2021. We all know that it's been a most difficult year because of the pandemic. And one of the key issues that has come up throughout this year has been tax issues. And so I think it's prudent that we prepare ourselves for 2021 because the uncertainty continues. So we hope that you all brace yourself for an engaging public lecture to learn more so that we prepare ourselves for the coming year. And so without much ado, I'd like us to bow down our heads for a word of prayer. Our gracious and heavenly Father, we thank you that you have been good to us. It's been a very disruptive year, but by your grace, we have survived so far. We thank you for how far you have brought us. We commit this public lecture into your hands, our speaker, our chairperson, and also all the participants dotted around the country and around the world, praying that this will be a really thought-provoking lecture that will teach us many useful lessons to prepare ourselves for what lies ahead of us in the coming year. We thank and bless you in the name of Jesus. Amen.
Amen.
Distinguished ladies and gentlemen, as is always our custom, we would usually use our president, the president of the institute, as the chairman for the public lecture. And so it is my privilege and honor to introduce our chairman for this afternoon's occasion in the person of Professor Williams Atulek, the president of the Institute of Chartered Accountants, Ghana. Mr. Chairman, your audience. Thank you.
Thank you very much, Abigail. And members, you are all welcome to this public lecture on a very important topic. I hope that all of you will get actively engaged so that we will have our resource person take us through, after which we will ask questions and there is some feedback. So if we can all mute our microphones so we can minimize the feedback. Thank you very much. So we will all stay engaged and listen to our presenter to take us through the tax environment for sustainable business growth, the toolkit for 2021. The tax is a very practical subject matter for all of us as practitioners, accountants, working in business, working in education, or in audit practice or assurance, and in advisory. So, and those of us working in government. So tax is a very relevant matter that we should all get familiar with. From the government point of view, government will want to raise as much revenue as they can in order to have the resources to execute the developmental agenda that they so desperately need to get the people of Ghana happy. Then, from the taxpayers' point of view, it's very painful paying taxes. So taxpayers will want to do whatever that is legally legitimate to organize, arrange their transactions in a manner to minimize the tax that they will pay. So we have to now, as accountants, serving both government and business, to find a way, to make everything fair and equitable. Now we have a very turbulent environment with the onslaught of COVID, throwing businesses out of gear, and then also destabilizing government plans to raise, tax revenue. So what is in all of this, in this very unstable, turbulent environment, how can we make businesses stable and grow? And what can governments do to support that? And that's practitioners, accountants who advise both government and businesses and taxpayers with respect to taxation. What can we do to ensure that there is sustainable growth in business? So our resource person has prepared himself thoroughly. He's a very seasoned tax practitioner himself. So he will give us the toolkit for 2021 that we all will use in this turbulent business environment to ensure that taxation doesn't destroy businesses, but makes businesses to grow. And then also at the same time, doesn't deprive government of the needed resources to develop the economy. So I will not take the win out of the sail of the presenter. I will want for all of us to stay and listen to him attentively. When he is done, we can ask questions, and then I will present the closing remarks. So I will hand over back to Ms. Abigail Ama to continue introducing the speaker, and then the speaker will take us through, ask questions, and then we can wrap up for the day. So Abigail, thank you very much, and I hand over to you to continue.
Thank you, President Chair. And so, distinguished ladies and gentlemen, we have as our speaker the managing consultant of ICAG and Associates and managing partner of ICAG Chartered Accountancy. He is a chartered certified accountant and a chartered tax practitioner. He holds a doctorate in business administration and Master of Applied Business Research degrees from the SBS Swiss Business School, Switzerland. He also holds a Master's Business Administration degree, IT Management from University of Leicester under United Kingdom and postgraduate certificate in Contemporary Business Management from Noble International Business School, Ghana. He also holds a Bachelor of Law degree from the Ghana Institute of Management and Public Administration. He is a fellow of ACCA, a member of ICAG, and also a fellow of CITG. With several years of working experience under his belt, our speaker is currently responsible for strategy, business development, client management, people development, quality assurance, and risk management in the firms he is managing. He has previously worked as tax director with Ali Nachia and Associates and tax manager at PwC, Ghana, where he specialized in the delivery of audit and assurance, tax and financial management support to private businesses as well as governmental and non-governmental organizations. Other portfolios he has held while in PwC led him to undertake assignments in Liberia, Sierra Leone, and the Gambia. He currently provides tax compliance and planning services and representations for clients with GRA in acquisitions, amalgamations, and reorganizations, tax audits and health checks, transfer pricing, oil and gas, mining, financial services, and manufacturing. Our speaker has previously worked with the Customs Division of GRA as internal auditor and later as tax auditor. He has previous experience as a lecturer in tax and fiscal policy at UPSA School of Graduate Studies MBA program. He also lectures tax planning and administration at Pentecost University Graduate School on the MCOM program. He is a resource person facilitator for ICAG's post-chartered diploma program in oil and gas. He served on ICAG's Technical and Research Committee. He is currently the Dean of Tax and Fiscal Policy Faculty and a member of the Professional Standards and Ethics Committee. He was the honorary treasurer on the Council of CITG and a past president of ACCA Ghana Network Panel. Our speaker was involved in tax advocacy work in transfer pricing with Christian Aid Ghana, the Private Enterprise Federation in the area of MSME taxation. Distinguished ladies and gentlemen, we welcome our speaker, Dr. Isaac Nyami, to make his presentation to us this afternoon. Thank you. Dr. Nyami, your audience.
Hello? Hello?
Yes, we can hear you.
Okay, good afternoon, Mr. Chairman, fellow participants, and all protocols observed. Good afternoon to you all. And first of all, let me share the slides. I'll be speaking from my slides, so I'll just share my slides with you, and then we take it from there. Just give me a few minutes. I'm trying to get myself together on Abigail, please, can you see my slides?
No, I can't.
You can't. Just trying to. I think I have a difficulty. Please come back with me.
Distinguished ladies and gentlemen, let's give Dr. Nyami a few minutes. He's experiencing some technical challenges. He'll soon be back up with us. Thank you.
Want to share the screen?
Yeah. Okay, yes.
Yes, we can see the slides now. Thank you. But you are muted, so please, if you can unmute. Thank you.
Okay. Okay. All right. What about the camera? Do we have to keep it? Can we put the camera off? I think the share will have the. It's okay.
Just put the camera off.
Okay.
Ask whether they can still see you. Whether they can see the slides.
Can you still see the slides, please?
Yes, we can.
Okay. All right. Thank you very much. It's been a bit difficult. Okay. Thank you. Good. So good afternoon once again, and sorry for this technical hitch. Okay. So Mr. Chairman and all participants, all protocols observed. So my honor to relate to you this afternoon with this topic, managing the tax environment for sustainable business growth, a toolkit for 2021. I think Mr. Chairman has said a lot already, and I think I just go straight to the presentation. Now, the essence of it today is to appreciate the tax environment and the role of each stakeholder in a tax environment. And we also appreciate the concept of sustainable business growth and the role of tax management in ensuring sustainable business growth in 2021. We also understand which practices to adopt in 2021 to ensure that we can be on top of our businesses and we can still be able to sail through 2021 successfully and be more profitable. So a few abbreviations that I'm sure later when I share the slides, we share the slides with you, you'll be able to relate more specifically. But we have these abbreviations that you'll find in the slides. Basically, by way of introduction, I think we all know the times now. The times has been the fact that there have been a pandemic and we cannot continue to stay mourning all the time. We need to recover from the impacts the pandemic had on our lives and our livelihoods. Many people may have lost jobs and others are struggling to make ends meet. But at the end of the day, businesses still will be the ones that would be able to lift us up again. And so we are trying to recover from this situation. But again, the obligation to pay tax remains. So recovery may be slow, but with proper management of our affairs, we can grow sustainably. Managing the tax environment in 2021 can guarantee some sustainability in business growth. And business will have to develop strategies or cultivate a healthy tax habit in order to maximize their cash utilization. So this public lecture will provide some kind of toolkit for us, for our businesses to use as a checklist and to ensure sustainable business growth in 2021 and beyond. Now, let's first of all understand the tax environment. And even though we may not have a specific definition of tax environment, but we could have some areas to look at. And we can explain the tax environment by looking at what constitutes the tax administration. We look at the taxpayers, we look at the tax laws, the tax statutes, and we look at industry-specific issues, because taxation is a subject that tries to, apart from the general framework of taxation, there are laws that are quite specific to certain industries as far as taxation is concerned. And so we'll take a look at all of that. These are all the environment. If we understand, the essence of it is to understand the environment very well. And when we do that, what helps us, what then happens is that we are able to manage it. We manage the environment from a position of knowledge as opposed to a position of ignorance or hearsay. And so when we say tax environment, these are the 4 areas that we are looking at. Now, and so we'll try to explain what the tax environment is by looking at the regulators. And this includes GRA and tax policy makers. And we know that GRA is responsible for the administration of taxation in the country. That is their mandate. And that mandate remains so. And they are the only bodies responsible for that. Of course, they may have some agents like the GIPC may be doing stuff on behalf of the GRA, the Free Zones Board may do things on behalf of the GRA, but whatever it is, the GRA remains the ultimate government organization that is responsible for the administration. Tax policy tax policy makers comprising the Ministry of Finance, the tax policy unit of the Ministry of Finance, Parliament, and to some extent, and tax practitioners are all players or regulators in a way in a tax environment. We also have taxpayers, which are the focal point for tax administration, and we also have individuals, partners of self-employed and employees and entities, including companies and trusts. In terms of the tax statutes, we're talking on the tax laws. Statutes comprise the laws, rules, and principles that govern taxation of gains and profits. So statutes include the Constitution of Ghana, the Tax Acts, and related regulations, practice notes, private or class rulings, treaty agreements and protocols, case laws, and other relevant laws. And so these are the tax statutes. And I say other relevant laws because, if you recall, I mentioned that there are certain laws that do not come directly, that are not directly managed or administered by the GRA. For instance, the Free Zones Board does quite some work, has some provisions relating to tax, and the Free Zones, apart from the Free Zones, we also have the Ghana Investment Promotion Center Act. And so these are other organizations and they are relevant as that are also applied to tax, that when we are doing taxation, we must always take note of that, especially matters relating to direct foreign investment, DFIs. Now, FDIs. Business environment would include taxpayers. Basically, this is where taxpayers transact their day-to-day activities, which result in gains or incomes and profits. And activities in the business environment include arrangement, sale, transfer, vocations, professions, trade, cross-border transactions. This is what we see. These are the triggers. These are the things that taxation seeks to direct. In other words, taxation seeks to make gains from. And so the business environment is also there. So you can see we have a broad spectrum of stakeholders, taxation stakeholders. And these are the key players in the taxation frontiers. Now, we can now talk a little bit about managing the tax environment. And managing the tax environment is crucial if we need to recover from the impact of COVID-19 and also grow. And therefore, an entity planning to recover from the effect of COVID-19 should efficiently plan their tax and other compliance affairs. So, we will consider the following steps in a bid to manage the tax environment going into 2021. And these are normally the usual management tools or methodologies, including the planning, organizing, implementing, and control. And doing planning, taxation is a strategic matter in current times, and taxation must be looked at carefully in order to ensure business continuity. And therefore, we require some serious skills there to manage taxation. For instance, we need some technical skills, knowledge of law, and the workings of the Ghana Revenue Authority, knowledge of law, and practices. We also need interpersonal skills. We need to relate to the Ghana Revenue Authority, the administrators, so that we would be having the attention to address our issues, and the other things like conceptual skills. But to talk about these activities to manage the tax environment, in the area of planning, we will need to set tax objectives for 2021, understand the tax environment for 2021, identify tax obligations in 2021, estimate tax payable in 2021. This estimate, I'll talk about it a bit more later. We will also organize ourselves as taxpayers and stakeholders in the tax arena by organizing documentation and information needed for 2021, including budgets, including the returns that we will be filing. So tax compliance documentation for 2020 is also useful for purposes of 2021. And then we'll set deadlines to meet tax obligations, compliance requirements. So we have to be organizing. We would also implement what? Set up the internal systems and procedures to avoid non-compliance, assign roles and responsibilities to individuals, provide resources to meet tax obligations or compliance requirements. And so we would have a series of activities to undertake in order that we can implement the objectives that we have set for ourselves. And again, the last but not the least is about control. Continuously review tax projections, because if you look at the estimate of tax payable for 2021, it's merely an estimate. And sometimes in doing an estimate, it is possible for a taxpayer to overestimate or perhaps underestimate. And when this estimation is not properly done, it has some implications for certain costs that will not necessarily be budgeted for, like the penalties and fines and other reputational risks that come with it. And so it is important that we continuously review the tax projections to make sure that within the time frame of 1 year, we are able to do a projection that is as close as possible with the actual. We also have to conduct, for purposes of ensuring the control, conduct tax health checks or audits or due diligence as is required. Sometimes it may be required to get independent people to come into your organization to undertake a kind of tax health checks and see whether the system is complying with the responsibilities that the tax laws impose on the business. And also, we would monitor compliance controls, procedures, and activities. So, in our topic, we said managing the tax environment for sustainable business growth. Every business, every entrepreneur, every organization desires to grow and survive, grow as much as they can. So business growth, and sometimes when the growth is not coming, it's very discouraging. If I may quote from the book of Proverbs, it says that hope deferred is sickening to the heart. And hope, you cannot continue to defer your hope forever. You must see growth in the business. And that's hence the reason we are even here together this afternoon, to see what we can do to ensure that we can have some reasonable growth even in difficult times. So sustainable business growth is the maximum growth rate achievable by utilizing existing cash flows without increasing in debt, without increasing in loans. In other words, you are able to, with the available resources as it is now, we should be able to use these resources to be able to add value by growing. Now, it is a growth that can be achieved given the company's current profitability, asset utilization, dividend payout, and debt ratios. And cash flows can be increased when tax affairs in 2021 are properly managed. And properly managed in the sense that you don't end up getting caught up in non-compliance matters, which takes away even the core time, the time that you should be investing in the business. And you may have to do a lot of running around at the GRA because of something that has not been complied with. So it is important that we manage all that properly. And a healthy tax habit must be adopted for 2021 in order to enjoy sustainable business growth. So growth is very important, growth is very exciting, and growth is very commendable. And growth comes with rewards. And we all aspire to grow in the various things we do, including our businesses growing by way of market share, growing by way of profitability and returns to shareholders. So I mentioned that a healthy tax habit must be adopted for 2021 in order to enjoy sustainable business growth. And so let's look at some of the habits, the tax habits for sustainable business growth in 2021. We will have to adopt a tax compliance culture within existing tax environment. Some of these things, we know them already. Failure to comply is not necessarily because of ignorance of the law. In any case, ignorance of the law is no excuse. But then there are certain things that we know. Sometimes GRA gets involved with us and they educate us. And also by this kind of platform where all of us as accountants meet and talk about tax, we get educated. And so we are fairly aware of the existing tax environment. We need to keep, and so we also need to continue to do that, because sometimes knowledge begins to fade if we do not try to basically refresh ourselves with the new knowledge and even the existing knowledge. We have to keep abreast of government's tax measures for 2021. You can see the president said something that I think I like so much. See, he mentioned that taxation is something that is so key, because government must, whether it is your government or somebody else's government or somebody's party, from government from any party, all of them have one singular obligation to ensure that they're able to provide what they have promised in their manifestos when they were coming into government. And so money is needed, resources are needed. The problem, again, is where do we obtain these resources from? Are we going to be borrowing all the time, or are we going to look internally and find the money? And so it is important that, and they have all that kind of, they have all the mandate to be able to raise money internally by way of taxation. So at any point in time, as accountants and as business managers, we need to ensure that we keep abreast of government's tax measures, including the ones that are likely to come in 2021 when the new government settles in. We need to take advantage of tax incentives available in existing laws and incoming tax measures. So it is possible that the incoming government is likely to look at certain particular industries and want to help them, give them some tax incentives to be able to do better. We need to have our ears on the ground and participate actively in getting to know what is happening in the tax environment. So the tax incentives that are likely to come, we need to take note. We also have to take advantage of tax administrative privileges that are embedded in the laws, our current tax laws, or any new tax laws. We also need to focus on managing certain expenses, what that we call allowable expenses, and make use of tax credits as well. We all know that if we have a lot of allowable expenses to reduce our turnover or our revenues, we are likely to have a very smaller tax base and pay lower taxes. And these are all things that can be done legitimately, not against the law. It's not invasion, but it's all part of compliance and planning matters. So we have to take advantage of allowable expenses and use the use of tax credits. Sometimes the way we organize our records relating to tax credits that are due us makes it impossible for us to use the tax credits. And so we need to pay attention to how those kind of credits, which are actually our tax assets, are utilized going forward. We have to make use of post-pandemic recovery measures relating to taxation. Government introduced a number of recovery measures, call it stimulus packages for taxation purposes. And in 2020, 2021, tax audits would want to see whether people did not take undue advantage of that. And so there'll surely be audits, and there'll be efforts to make sure that people have used the right amount of, or have claimed the amount of release that are available to them. So post-pandemic recovery measures relating to taxation, we have to take note of that. And we have to leave behind harmful tax practices and be determined to survive in 2021. There must be hope for us, and the hope is when we do our things well, the system will help us. And we as professionals will have to encourage ourselves and our clients to make sure that certain things that they do by way of harmful tax practices, including evasion, are stopped. So, talking about the knowledge about government's tax measures for 2021, there's a little that this particular slide contains certain procedures that are going to be followed to be able to get to a level where we'll get to know the mind of the government in 2021. The 2021 budget will give a snapshot of tax policies and reforms to expect in 2021 and should have been read in 2020. But we know that 2020 has been an election year, and as the Constitution demands or the law demands, it's not possible for the current government at the time to come out with a budget when it is not known whether they will continue in government or another government will come. At least now we know what is happening. So instead of that, in fact, and the law says that is a Public Financial Management Act says that Section 21 of the Act requires the Minister of Finance to lay before Parliament not later than 15 November for each financial year a budget. So that is the requirement of the law, but that was not done as in full-blown budget because of the fact that it was an election year. So the budget was not read due to the 2020 elections. Instead of that, expenditure in advance of appropriation was presented by Minister of Finance to Parliament on 29 October 2020. So something to keep them going by way of expenditure. And that was approved for them at the time to be able to run through the 2020, the rest of the 2020 and part of 2021, if possible. Then the budget for 2021 will be presented by the new government within 3 months after taking office. And the direction of government fiscal policy may change or remain the same depending on the focus of the new government and balance of power in Parliament. And I said balance of power in Parliament because with the way the Parliament is so balanced now, whether it's going to be that easy to be able to raise funds from abroad, where they have to, especially by way of loans. And so this is something for us to watch. But in the absence of anything, government has got the other option to look for money internally, either by borrowing internally, which might have implications for our interest rates, especially crowding out the private sector, possibly. Or the other thing to look at seriously is to look at our taxation and refocus and see whether we can increase some taxes, introduce some new taxes, or just allow it the way it is. And so that's just by way of what government measures will be in 2021. But again, we can expect some trends in 2021. And so the question that one can ask is that, is it likely that there will be a change in the graduated tax rate for individuals? Taxation of individuals, especially those in the formal sector, is the most easiest thing to do, I think, in my view, because the system is quite structured. I mean, taxation of individuals especially the employees of organizations. And somewhere, was it 2018, the tax bands, the graduated tax band was expanded, and from is it 25,000 to as much as 30,000, and it was. We all complained about it. In fact, ICAG also wrote, basically presented a paper to reduce the tax band that is in the highest bracket of 30% to say 20%. And thankfully, there was a change in the law to reflect that, the government listing. So is it possible? Is it possible to increase the tax rates? Is it possible to reduce the tax rate? And looking at the fact that we are in the COVID has not gone away yet. Especially, we are just fortunate in Africa. But at the moment, we do not know if it has created a lot of uncertainty, and whether, because there have been a lot of efforts by government to reduce, to especially the frontline health workers and etc., to be able to continue to work hard in order to stem the spread of COVID. And so this tax rate is something to watch as we go into 2021. Again, tax incentives to encourage some sectors of the economy. We know that manufacturing produces a lot of jobs. Much of the manifestos, both for all the major parties, have been talking about job creation. The more manufacturing entities we have, the likelihood it is for many people to get employed. So manufacturing plays a very important role in taxation. Are they going to give some more incentives to manufacturers to so that more can go into manufacturing or production? So manufacturing stands a high chance of getting some tax incentives for purposes of creating more jobs. Is it possible for introduction of new taxes? We don't know yet, but this has to be something that most of the time you find it happening in new budgets. Or is it possible for reduction of new tax rates, of some tax rates? Yes, it may be yes, maybe no, but it's something we have to watch. Remember a couple of sometime recently where we decided to decouple the VAT and call it straight taxes. So in so doing, somehow the tax that government was able to make, or the tax yield, increased somehow marginally. There were certain taxes that we called nuisance taxes, like for instance the vehicle tax, where we those things have now all been repealed. So it is possible that government will look closely and see which other taxes are nuisance taxes and decide to get rid of them. Recently, communication service tax, what happened? It has to be reduced so that making communication available to all and making it more affordable. Again, scrapping or abolishment of some taxes. Who knows? National Fiscal Stabilization Levy might be abolished. I'm not saying it will be abolished. It may be abolished because it's one of the taxes that we think that has overstayed is welcome. And we have made a lot of presentations or representations to government, and they have said they will do it by a certain period. I think 2020 just escaped me, but they will do it by a certain period. It may be possible for them to change their mind and decide to scrap it now. Amendments of tax laws and regulations is possible because there are a number of taxes or areas in the taxes that require some amendment. So this will be normal features that will happen in 2021. Tax administration reforms and restructuring. Currently, the GRA is doing well by reorganizing from the start, the establishment of the reforms. When the reforms started a couple of years ago. I think the reform is over 10 years now. And they have recently reorganized the way they want to deliver their tax audit activities. And so they have reorganized, and I foresee going forward, there will be a lot of tax audit activities across the country. This is something that we all need to be aware of and also need to ensure that we are organized and prepared for it. Again, they have done some internal restructuring and converting certain offices to taxpayer service centers. And certain activities are concentrated there, and certain activities that are not so core to taxpayer services are taken away from those kind of centers. And so the reforms are ongoing, and we hope that those reforms will be very, very, very useful to taxpayers and make sure that taxpayers do not suffer unduly, and the GIA will be able to also do what they have to do to ensure that they can mobilize enough revenue for government. A question one can ask is whether or not there could be extension of post-pandemic recovery packages. These are things that can happen if the pandemic continues to plague us. And so, there could be basically a reduction in the packages that are available. So in terms of trends, these are what I can talk about for now. Adopting the culture of tax compliance is very key. Taxation really starts with tax compliance. And compliance basically requires, under the law, that the taxpayer has certain obligations to the tax authorities. And so tax as advisors, as auditors, and as accountants at various places, we need to have a certain culture of ensuring that we comply with the tax law, and we also advise our clients to comply with the tax law. So efficient tax positioning commences with tax compliance. And compliance is the actions taken by taxpayers to meet their tax obligations under the applicable tax laws. The culture of tax compliance is important for sustainable business growth. And the tax compliance saves the business from penalties, interest, court charges, and fines. So tax compliance basically reduces the risk of preemptive assessments and tax audits. Preemptive assessments normally happen when the the GRA feels that, or the tax law feels that tax revenue is at risk. And if tax revenue is at risk, if the tax revenue is at risk, then it means that they will do everything possible to recover their taxes. For instance, tax revenue is at risk where sometimes a business is closing down. Tax revenue is at risk where an entity closes down and leaves the country, or non-residents are leaving the country. And a number of things can trigger tax revenue being at risk. So the GRA can take steps to carry out a preemptive assessment and try to recover the taxes before certain events happen. Tax audits are normal part of their processes. And again, so if the GRA comes to the tax payer and has to spend some reasonable amount of time over there, it takes away the attention of the taxpayer from carrying out its normal activities, and therefore that might reduce their ability to get more revenues and taxable profits. So having a good culture of tax compliance helps. And tax compliance helps by avoiding the cost of non-compliance cash flows, and therefore cash flows is preserved or increased. Now, tax compliance culture to practice in 2021 will include the need to register for tax. And to register for tax is to avoid tax imposition due to late non-registration. Certain companies, entities are supposed to even register for VAT, but they have not done so. And the law is said that when the tax authorities come into contact or to become aware of this, the tax law requires them to impose the taxes on such entities or persons from the day when they should have been registrable. And so there's the need for taxpayers to have a good tax compliance culture by knowing the registration requirements, using the appropriate forms to apply, displaying the registration certificates at their offices. These are all requirements of the law, especially the VAT Act. And so registration is very important as part of the tax compliance culture. The next thing to consider is that to deregister for tax. Sometimes situations come up in such a way that the business does not continue to operate. And some of them become dormant. Some of them just basically cease to operate because the situation does not help them. And so to avoid incorrect assessments or late filing penalty, it is important that entities that are not going to continue to operate into the foreseeable future basically have to take steps to deregister themselves from the tax authorities. But what is important to know to do is to know the requirements for deregistration, especially for VAT, because if an entity that is not in operation does not deregister, then the law presumes that they are still in operation, and they have a requirement to file VAT returns at the end of every month. And that filing of the returns, if the entity fails to do that, penalty is triggered. And we know that for failing to, as soon as the first deadline for filing crystallizes, then they have to pay 500 Ghana cedis. And then for each subsequent days of default or filing of a VAT return, there's 10 cedis penalty and forever. And GRA would force to get all that money if eventually the company decides to deregister. Taxpayers must also know, must also be made to settle outstanding tax obligations if you are deregistering, and deregister to avoid the late filing penalties of 500 Ghana cedis spot and then 10 cedis per day for returns not filed. Again, adopting the culture of tax compliance, we can look at withholding tax. Withholding tax at appropriate rates and remit tax withheld to the Ghana Revenue Authority on due dates. So for withholding tax purposes, and this is something we should all look at, we have to, first of all, be able to identify the nature of payment, confirm the value of the transaction, ascertain frequency of transaction with supplier, and that the essence of this is to ensure that the threshold withholding tax will only be deducted when the threshold of 2,000 Ghana cedis for goods, services, and works are exceeded. And so we need to take note of that. We need to apply the appropriate rate on the gross amount. Certain times, people calculate the withholding tax on a wrong tax base. And so the tax base normally on withholding tax, for instance, for services, must be the actual fees for the services. It does not include fees and other levies like the Get One levy and the National Health Insurance levy. No, it's just the basic amount of the actual fees. But people still make those mistakes even now. There's a need to use the appropriate forms to file the withholding tax returns, pay the tax withheld to the GRA by check preferably, request exemption letters if suppliers claim to be exempt from withholding tax, file returns by 15th of the following month, inform the Commissioner General within 30 days of entering transactions with non-resident persons. These are all requirements of the law and needs to be complied with. Again, claim tax credit certificates and send to the relevant suppliers. I have seen situations where certain organizations deduct taxes and from payment to suppliers, and they keep, and then they have obtained when they have obtained the withholding tax credit certificates, they keep them with themselves, which is not the right thing to do, because if they keep them to themselves, those certificates cannot be used by them. It has to be used by the suppliers to reduce their tax liability when they are filing returns. And so this is something that we need to watch carefully. Another culture that we need to look at carefully is to pay all type of taxes on time and at the appropriate rates. At the time of registration of an entity with the GRA, in completing the form, there are a number of taxes that the company will have to indicate that that will affect their businesses. So we have to know the applicable tax types that apply to the businesses. Is it company income tax or VAT or communication service tax or national fiscal stabilization levy or excise taxes, to mention a few? It is important that they are able to pay all these tax types on time and at the appropriate rates. Taxpayers must know how to calculate the tax, whether calculated on chargeable income or gross income or ex-factory price or total cost plus levies or accounting profit or CIF and duties. For instance, if you look at the tax rate that applies to the tax rate and the tax type that applies, up to 35% is supposed to be a corporate income tax, which varies per the business type. So in petroleum, the corporate tax rate is 35%, but normal business is 25%. But also there could be rebates of company tax. So some companies that may have some locational incentives may pay far lower, like 12.5%, others 17.85%. These are things that they need to know. Of course, the graduated tax rate will apply mostly to individuals, and that would be the PAYE taxes. Again, we do have flat rate VAT and withholding tax on goods, and 3% would apply. Withholding tax on works, 5% will apply, and the withholding tax on services to residents, 7.5% will apply. Withholding tax on dividend, interest, rent for residential purposes is 8%. Withholding tax on services to non-resident resident entities, 20%. These are all things that we must know at our fingertips and make sure that we comply. Know when to pay the tax should be by the date returns are filed. Normally, it's okay. The law even requires it, or sometimes even the law does not require it. It is just proper practice that when the returns are filed, it's accompanied with checks. For administrative reasons, know the tax office to pay the tax to. Remember, I was saying a while ago that the GRA is going through some reforms and has set up tax service centers, taxpayer service centers, and we need to know. Recently, we were called to tell us that they have moved our file from one office to another office, and I think they have done that to many of the taxpayers. So we need to know where we are supposed to be filing our tax returns. Filing of applicable tax returns on time. Timing is of essence in taxation. It's so key to taxation that when there's a failure to comply with a certain date and time, it becomes an issue, and penalties are triggered. So know the tax types that impact your business, and know the nature of returns which need to be filed. Is it an annual return or quarterly returns or monthly returns? Know when to file the relevant returns. For instance, withholding tax or VAT withholding tax or PAYE, we know that by the 15th of the following month. Excise taxes, 21st of the following month. Quarterly self-assessment, company income tax is paid quarterly. Annual company income tax returns is paid by the 30th of April, or 4 months after the end of the company's business period or year of assessment. And sometimes there's also the requirement to ask for extension. So if there's an extension, then they will not be able to pay within the 4 months. It will be extension by some 2 months. Then before the end of the extended period, then payment must have been done, etc. It's very important. Use the appropriate forms when filing the returns for the relevant tax types. I have always been told in my early days in learning taxation was that if you provide information to the GRA on the wrong forms, it means you have not complied with the filing requirement, and that the GRA has the right under the law to impose penalties. So the forms that are used are so key, and we must be conversant with those forms. We have to attach the necessary schedules or documents, for instance, capital allowance and company income tax computations and payment checks. Talking about schedules, sometimes this helps in even if the GRA does not ask for it. Company income tax computation is something that should often be submitted. It will give them a guide, at least get from your point of view how the taxes were computed. They would either adopt that or they would try to make some adjustment to that for purposes of finalizing the tax assessment. Again, we're looking at the culture of tax compliance and the culture of keeping proper tax records. We need to know the type of records to retain for tax purposes. For instance, GRA official receipts, the GRA returns, tax credit certificates, sales records, etc. We need to know that the burden of proof lies with the taxpayer. It is possible, and this is something that happens in GRA, that they give you a document and they keep a copy, and if you don't keep your copy well, and they have to come and conduct a tax audit, they will ask you to provide your copy. If you don't have it, they will tell you they don't have their copies either. Or sometimes you go onto a file in the GRA offices and you find that most of the documents that you as a tax consultant or a taxpayer has, they have misplaced the copies that are supposed to be available to them. And so again, the onus of proof is on the taxpayer. And so gives us additional work. We believe that GRA would improve their systems to ensure that they keep the records well, so that they can relate to the records that are maintained with them in their offices. Use hard files or digital documentation tools, such as flat files, folders, cloud space like Google Drive, etc., to keep the records. Label files appropriately. For instance, 2020 TCCs must be properly organized and kept. Make documents easily accessible and have a good archival system. Easily accessible because if the documents are not easily accessible, GRA may not have time for you to to go providing documents when you should have it. And so they may eventually just have to use what is available to them to make an assessment that may not be fair to you. So it is very important that an entity is proactive enough to have a good filing system for its tax records. They need to know when to destroy documents. For instance, documents cannot be destroyed anyhow. If at all necessary, keep documents for at least 6 years. That's the law. The law requires that you must keep documents for taxation purposes for at least 6 years. And no procedures in destroying documents. You need to apply to Commissioner General for approval before destruction where it has got to do with excise. But in the case of other taxes, which is administered under the Revenue Administration Act, that the law requires that you must keep records for at least 6 years. Talking about transfer pricing, which is a very topical issue, that has been a topical issue for some time now. Again, we need to look at the culture of tax compliance as far as transfer pricing is concerned. So transfer pricing documentation for entities related party transactions. We need to maintain master and local files contemporaneously. In other words, every records must be kept at the same time, master file and local files. However, transfer pricing documentation is not required for the following category of taxpayers. Remember, and the old transfer pricing regulation was repealed recently, and the new one has now come into effect. And the new one is that what we're discussing here now is the requirements of the new ones. The new transfer pricing regulation, 2414, transfer pricing regulation. However, transfer pricing documentation is not required for the following categories of taxpayers. Taxpayers who are party to control arrangements with value of up to $200,000. In other words, even though there's a transaction between related parties, if the transaction is not up to $200,000, then they don't need, these parties are not supposed to file transfer pricing documentation with the GRA. Taxpayers involved in low value added intergroup services, which satisfy the Commissioner General's criteria. And by election, the persons involved in control arrangement pursuant to a technology transfer agreement, which is registered with the GIPC, and for which the applicable charge is less than or equal to 2% of net profit, are not supposed to charge to maintain or file this documentation with the GRA. Taxpayers who do not qualify for the safe harbors described above, transfer pricing documentation should be filed no later than 4 months after the end of the business period. So you see that as far as transfer pricing is concerned, it is required that these transfer pricing returns are filed with the GRA, just as the company income tax returns are filed 4 months after the end of a company's business period. Also, there's a requirement to file a country-by-country report for multinational enterprises with annual consolidated group revenue of 2.9 billion or more. So our law has now adopted one of the BEPS recommendation, base erosion and profit shifting recommendations, that we need to maintain country-by-country report for entities that are more of multinational enterprises and that have got consolidated group revenue of 2.9 billion or more. Records relating to that must be filed with the GRA. Note that the first step to an efficient or progressive tax environment is tax compliance. In fact, zero tolerance for tax non-compliance. We need to have a zero tolerance for that. We must make sure that as for tax compliance, this is something we should do without incurring the wrath of GRA. So without a tax compliant culture, even the most robust tax planning schemes will crumble. Tax compliance, different from tax evasion. The whole tax administration starts with tax compliance. And so it is important that we feel comfortable and organize our systems in a way that we can comply with the requirements of the law by undertaking tax compliance religiously. Another thing we can look at in 2021 or take advantage of is to make use of current and new tax incentives or concessions that are likely to come up. Now, why do we do that? Because we have to do this to ensure that business cash flows in 2021 can be increased if businesses engage in activities that give them the best tax advantage. Thankfully, the tax laws provide for incentives. Any incentive that cannot be located in a tax law, please, is not an incentive. The incentives must be located in the tax law. And many people miss the opportunity to reduce their tax liability because they don't take advantage of the incentives. Tax concessions help businesses to reduce their tax costs. And in 2021, businesses should plan their tax affairs so that they can enjoy applicable tax incentives. Also be on the lookout for new incentives in the 2021 budget, if any. Keep in mind the traditional tax planning variables. For instance, location variables and activity variables, time and entity principles, in addition to specific incentives provided in the Act. From our work, we have seen situations where, because of ignorance of the incentives, certain taxpayers end up paying tax at the rate of 25%, even though they are supposed to pay tax at the rate of 12.5%. And so, auditors, for that matter, who are the auditors are the frontline advisors to many businesses, should have a fair knowledge of these incentives. Where is the entity located? Is the entity engaged in manufacturing? Or what is the activity of that particular entity? The law provides for some kind of incentives to reduce the tax liability and to encourage that particular entity in that particular industry so they can do more for purposes of generating profits and also paying the appropriate taxes. So keep the traditional tax planning variables in view. Also remember that in the tax law, there are certain incentives that are not identified with any of these variables, but they are there. There are tax planning opportunities in the tax law that we need to know and make sure that we can advise our clients accordingly. So available tax concessions businesses can take advantage of in 2021 would include the following. Partial tax holidays for farming business, agro-processing business. We can see it in the sixth schedule of the Income Tax Act. Incentives for young entrepreneurs engage in specific activities, including medicinal plant, ICT, software development, etc. These are all incentives in the tax law. Tax exemptions for some sectors, such as the free zones, automobile businesses, mutual funds, and talking about mutual funds. So they have they are exempt from tax, and even management fees do not attract VAT anymore. There are certain incentives that are so available that if the entity that is not aware of the incentives, it may not be able to apply to reduce its tax liabilities and tax obligations. Reduce tax rates for some sectors such as hotel and entities engaged in export of non-traditional products, banking, for instance, banks that are involved in granting of loans for leasing purposes, and also for farming enterprises. Corporate tax rate of 20% instead of 25% applied to such incomes by banks. Additional locational incentives for manufacturing, free zones, farming businesses, even after their tax concessionary periods. These are things that we need to be investigating and advising our clients to use. Again, deductions or expenses are legitimate claims by businesses before arriving at the taxable profits of these businesses. So we need to be wary of expenses that should serve the business purpose of the businesses. The law says that expenses must serve the business purpose of it must not be private expenses of the individuals that operate the business, It must be business-related expenses. And so note that expenses will be allowed for tax purposes if it qualifies under the general or residual or specific deduction rules. And generally, expenses should be wholly, exclusively, and necessarily incurred for purposes of generating the income. The specific rules, deduction rules, include tin capitalization rules. Examples of tin capitalization rules: limitation of foreign exchange deductions, limitations on repairs and improvements, rules on trading stock, interest, etc. Specific deduction rules take precedence over more deduction rules. Specific deduction rules take precedence about when there's a conflict between the deduction rules. So we go to the specific deduction rules. Now, apart from those expenses which are wholly, exclusively, and necessarily incurred during the income generation, specific rules will apply to determine the extent of deductibility of the following expenses. Particular attention must be paid to interest relating to deductions relating to interest on loans procured for purposes of assets or used for generating income. Trading stock allowance. We know, as accountants, we know that if you want to get cost of sales, we do opening stock, we add purchases, and we less closing stock, and that is our cost of sales. These are allowable deductions. Repairs and improvement costs relating to repairs and improvement costs, up to 5% of written down value of assets in a pool, but the excess is capitalized. We need to give attention to research and development. All of these things are specific, they fall under the specific deduction rules. And when the law says it's specific, it means that there's no other law other than that law that regulates the deductions. And so it is specific, and the rules must be followed to the letter. When a thing is not specific, then we have to go to the general rule. And why we say that the thing, it is wholly, exclusively, and necessarily incurred in the production of in the generation of the income. And so that is more general. We also, for specific deduction rules, we also need to give attention to what we call the financial costs and relevant financial costs. Financial costs will apply to general business, and relevant financial costs will apply to those entities in the extractive industry, like the petroleum and mining. We need to look at the provisions relating to bad debts. Bad debts generally, for accounting purposes, are deductions or expenses. But there are specific rules that apply to the use of bad debts for taxation purposes. We need to pay attention to that. We need to look at the way capital allowances are calculated on assets that are owned by the business and assets that are leased through finance lease. And remember that not the way IFRS 16 talks about lease, not relating to IFRS 16 lease, but finance lease. We need to look at the way we basically take advantage of losses, basically tax losses, not accounting losses, because accounting loss can be reversed into a profit. But where we have a tax loss, we need to know how to relieve it, especially tax losses that apply to entities in all sectors, not in the priority sectors. Then tax losses can be carried forward for a maximum period of 3 years. Then entities in the priority sectors like energy, power, manufacturing, tourism, ICT, mineral and mining, petroleum, agro-processing can carry forward their tax losses and relieve against future taxable profits over a period of 5 years on a first-in, first-out basis. So we also have issues carry back losses from construction contracts. So in terms of construction contracts, which straddle over several financial years or tax years, there will be eventually calibration of all when in the final year, there's a need to basically take a total look at the construction contract and know whether there is overall loss or profit. And to the extent that any losses that may have been granted and does not have profits to be set off against can be carried back to previous years and set off against those incomes that may have arisen in those years. We also need to be looking at the contribution towards worthwhile causes. if you recall, of course, there were specific things that specific things that were made available to entities that suffered during the COVID period. But under the law, we already have donations and certain things that are allowable for tax purposes. So charities, scholarship schemes, rural or urban development, sports promotion activities, others approved by Commissioner General. But charities must be registered with the social welfare. We need to look at the deductibility of loss from business or investment. We know that losses from business can be set off against future profits in business or investment income. But that of investment is only applicable to investment incomes if the losses occur, there are profits in the future. For instance, investment losses in the current year can be set off against only investment income in the future. Now we can look at some privileges also that we should take advantage of. Some privileges in applied for. For instance, always applying for extension of time to file returns or extension of time to pay the tax increases the risk of the risk rating with the GRA. If GRA does a kind of trend analysis and find that a company is always applying for extension of time to file, then they may begin to feel suspicious and may want to come over and do a tax audit. And so it may be one-off at a time, but it should not be a habit of asking for extension every year. So some administrative privileges available for use in 2021 will include application for tax refunds, the use of TCCs in paying self-assessed tax liabilities, applying for extension of time to file returns or extension of time to pay tax. But here, the taxpayer must show a good cause. Applying for private or class rulings is something that the GRA will willingly do. In other words, they would basically respond. And thankfully, these days, we have very quick response from GRA. Whenever there's an application for a private ruling, when there's a need to have a better understanding of the GRA view of treating a transaction. There's also the opportunity to ask for an objection to tax assessment, an application by applying to the Commissioner General for waiver of requirement to pay 30% deposit when that application is made. There's also objection to tax decision through an independent tax appeals board. There's recently the Revenue Administration Act has been amended to make a provision for the setting up of independent tax appeals board, where redress for tax assessments can be obtained instead of going through GRA directly. Or when GRA refuses to grant what is supposed to be you are asking for, you could make an appeal to the Independent Tax Appeals Board. The law is there now. We only look forward to the administration or the government setting up this Independent Tax Appeals Board, where people can go for redress, where GRA is unduly unreasonable, let me put it that way, for want of a word, unduly unreasonable with the kind of objections that the taxpayers bring before them. Application to Commissioner General for waiver of penalties and interest, where a good cause is shown. Voluntary disclosure of tax liability and payment of tax to avoid imposition of penalties and interest. Again, there have been some amendment in the Revenue Administration Act to the effect that where a taxpayer voluntarily discloses to the tax authority any tax liability and pay the tax before there's an audit, then the GRA can actually waive any actions relating to penalties and interest relating to that particular liabilities. We also need to be telling our tax payers to take advantage of tax credit Tax credits. Tax credits will be very useful to businesses that wish to improve their cash flows for sustainable business growth. So evidence of available tax credit will be needed before claim can be made to it. Such evidence include tax credit certificates, tax audit reports, etc. So there's always tax credits available, and some taxpayers may not even be aware of their tax credits and therefore cannot take advantage of the tax credit. Withholding tax credit certificates should be obtained from customers who withhold tax from the payments. Now, we have sources of tax credits or reducers available, including withholding tax credit certificates from suppliers made, official receipts for tax overpayments, foreign tax credit certificates, corporate tax paid on account, VAT withholding tax credits certificates, deductible input VAT from qualifying payments. There are a number of sources that we can actually obtain our tax credit evidence. And when we are doing our tax filings, we can take advantage of the tax credits in order to reduce our tax liabilities. Having said all of this, ladies and gentlemen, we need to also leave behind some harmful tax practices that in 2021 should be part of our New Year resolutions as far as tax compliance is concerned. So tax practices that would deprive the country of its due revenues should be discouraged by businesses. And we as professionals should not form part, should not give our attention to, or should not basically connive with taxpayers to go against the law. Businesses should stick to legal tax avoidance practices than tax evasion schemes. And businesses should remember the consequence of harmful tax practices that may be severe when those practices are uncovered. The Commissioner General may take steps to deal with harmful tax practices, and this could be costly to the business, especially in regards to reputational risk. And every time an entity may be in the news for the wrong reasons. And so harmful tax practices must be discouraged. Harmful tax practices to avoid in 2021 may include or will include money laundering activities, failing to file tax returns on time, failing to pay tax on time, failing to withhold tax from qualifying payments, and a couple of them falsifying or misleading a tax officer, impeding tax administration, failing to issue VAT invoices when one makes a taxable supply, to mention a few. And these things must be left behind in 2020. Others may include transfer mispricing, income splitting, intentional under-declaration of taxes, falsification or alteration and forgery of value books or source documents, willful underestimation of quarterly company income tax payable, aiding and abetting a criminal activity with the intention of basically evading taxes. Note that while the Commissioner General or the GIA officers identify such harmful practices, the penalty or interest which will be imposed may exceed any illegal tax benefits you may have been enjoying from engaging in such practices. Sometimes it is better to just comply than to try to outsmart the law. So we are almost there, and we are saying that make use of post-pandemic business recovery packages. Currently, the following packages are available to entities: VAT, National Health Insurance Levy, Get Fund relief on donations made towards the fight against COVID-19, as in donation made through recognized institutions. We have to make use of them. Donations in support of the COVID-19 pandemic shall be allowed as deductible expenses. There are certain things that we can do, again, relating to post-pandemic measures that may be available in 2021, possible extension of deadlines, possible deferral of payments, the law provides for that, possible waiver of penalties and interest, openness of the Commissioner General to take debts rescheduling plans. Generally, if you think that you cannot pay, the commissioner, you make an application to the Commissioner General to make an arrangement to pay over a period of time. This is that the tax administration is quite open to that. Temporary changes in GRA tax audit approach, COVID-19 protocols. For instance, at the moment, GRA is basically doing a lot of desk audit as opposed to actual tax audits. And if it is within your, if you think that is what you require, the GRA will be willing to listen to you. Additional exemptions and incentives to taxpayers may be available. Who knows when the new budget is read? Maybe in a couple of months after the new year. There are fiscal stimulus packages that called CARES that are being provided for also because of COVID-19.
Sorry to interrupt you, Doctor.
Yes.
You have about 5 more minutes.
Okay, I'm almost there actually. Okay. So, certain things we can take away from this is that the long and short of what we have been talking so far is that we need to manage the tax environment in 2021 in order to achieve sustainable business growth. And the first point of call should be to comply with the existing tax obligations. Then seek an understanding of the changes that may happen in the 2021 budget. We have to position ourselves strategically to be able to take advantage of all tax reducers or credits and all tax incentives. We should develop and implement healthy tax management habits that can ensure efficient cash flows management. Recovering from the effect of the pandemic and growing sustainably is possible, and it's possible indeed. So, to my final comments before questions would be that the situation regarding the tax environment is not for want of word, is not as abysmal as we think. There are opportunities in the tax laws that we can take advantage of. We need to also make sure that we structure ourselves in a way that we can be friends with the GRA when it comes to compliance. And in so doing, we will have a very good habit of tax compliance, and we will not have our businesses to be interrupted by the GRA when they need to enforce their law. I thank you very much for your attention, and I'm ready to perhaps respond to any issues that may have come to your attention. Thank you very much.
Thank you very much, Doctor. I'm sure if you were to read the comments, you realize that the audience have been captivated by your presentation. Thank you so much.
Thank you. Thank you.
So we have a few questions.
Yes.
Coming in so far.
Okay.
I'll take the first one from Ibrahim Azunga.
Okay.
His question reads, please, does the VAT Act allow for the imposition of slaughter fees on an entity that operates a slaughter slab, which is a place where animals are slaughtered? Because the slaughter slab services is within the agri-food chain. That's the first part. So let's take your answer for the first part of this question.
Okay. In terms of the VAT, under the Schedule 1 of the VAT Act, which is the exempt supplies, it says that sale of let's say local animals and local food crops are exempt from VAT. In terms of slaughter fees, in my view, and this is my personal view, the law says sale of. If the sale includes slaughtering and things like that, I think it should be exempt from VAT.
All right. So now he posted a second part to the question, the earlier question. And he said, a meat slaughterhouse has not been charging or paying VAT on slaughter services. After the entity submitted its accounts to GRA, They wrote an outstanding VAT for 5 years for payment. However, checks have showed that no slaughterhouse in Ghana pays VAT.
Yeah.
The people may avoid the slaughterhouse's services and kill the animals themselves. How should
Themselves.
the slaughterhouse argue its case to GRA?
Okay. I think that one way of approaching this is for all the slaughterhouses to make a kind of representation to the GRA about because you see the starting point again is the subject matter of the disposal of the sale is local animals. It's not imported animals, and the VAT Act talks about exemption from sale of local animals are exempt from VAT. So sale of local animals and sale, in my view, includes whatever processes that those local animals go through before they are sold. And so they have a strong case. They do have a strong case to be able to talk to the GRA regarding the interpretation of that exemption provision in Schedule 1. And I think that they have a very good case that they should be putting themselves together as an association. Many things are well thought out and well executed as far as tax is concerned when you belong to an association. Like, for instance, the Bankers Association, the Insurance Association. If you have issues, then it's very important that these slaughterhouses who are likely to be facing similar situations across the spectrum should put themselves together and engage with the GRA, and the GRA should give them a good answer. That's what I say.
All right, Doc. Thank you so much for this answer. I hope our friend Ibrahim Azunga will be satisfied with your answer. The next question is from Seth Owusu, and he asks, when should withholding tax be withheld? Upon payment or upon receipt of vendor's invoice?
Upon the law talks about withholding tax should be withheld on payments. The payments under the law means either the payment has been made by issue of a check or by issue of a check or actual a check or cash, or when the invoice that requires the payment is booked into the is taken note of by the company that is receiving the invoice. And so payment is either the money is actually paid or when the money is actually booked or accrued in the books of the company that requires to pay. And so on the basis of that, then it would then mean that whether, for instance, if an invoice is received and the invoice is entered into the payables records, then it means the payment is due immediately. Before even actual check is issued, payment is already due. So withholding tax must be taken at that point. And so that is one aspect that many people are not happy about. That, we haven't made payment. We haven't actually made any payment. But for us, we understand that when we are going to pay before we deduct the tax. So it can be there, that invoice can be there for 3 months, 4 months without payment. But the GRA is looking for is under the law. That's what the law says. It's looking for is withholding tax. And so once you have accepted the invoice and it's part of your payables, then it means that you should be actually preparing to pay as soon as possible.
All right, Doc. Thank you very much for your response to that.
You're
The
welcome.
next question is from Nicholas Amegbileto. And he says, what sanction is applicable for failure to deduct withholding tax? For instance, Section 1173 of the Income Tax Act requires withholding agents who fail to deduct tax to pay the tax.
Yes. The law says that if a withholding agent fails to deduct on payment, then the GRA will recover that tax from the withholding agent. In other words, ICA being a withholding agent, failing to deduct tax on payments for certain services, then the GRA goes to ICA to collect the money from ICA because they have the obligation, they are standing in as the commissioner for purposes of the deduction. Now, if the failure, so what then happens is that there's a provision that which is of the effect that once the first thing that GRA will do is to take the actual taxes that should have been paid, that should have been deducted from the payment, and then recover that first, and then surcharge a penalty. And remember, the penalty is tax is as a result of tax outstanding. And the tax outstanding, the penalty is I think 125% of the statutory rate, 125% of an interest rate. Currently, the interest rate is 14.5% of Bank of Ghana statutory rate. So 125% of that multiplied by the tax outstanding and compounded at the beginning of every month is the tax penalty that is likely to be paid. And so it is not a pleasant thing at all to fail to deduct, because the kind of penalties that will be exerted are rather punishable and very unfriendly. And so yes, he's right in his submission, and there's a need to ensure that the deductions are done on time and paid to the GRA also by the due date.
Thank you, Doctor. The next question says, does a manufacturing business registered as a sole proprietor enjoy tax incentives for manufacturing?
Yes. I think the thing about the tax incentive is about the activity involved, manufacturing. So let's in taxing that sole proprietor, he's being taxed first of all on his business profits or business income. And so in doing the necessary calculations of the taxes that are due from his business and taking advantage of any incentive, he has to take advantage of any incentives relating to the particular activity, which is manufacturing. And therefore, there will be some kind of tax incentives available at that point. So if the entity that has been registered is an entity which is a sole proprietor, then whatever is available to entities, to companies, must also be available to that particular entity as a sole proprietor. And so, yes, it can be done. It can be taken.
Okay. The next question is from Abigail Amwakwata, and she's asking if a company providing online services to an educational institution is exempted from VAT.
Not at all. It's not exempted. In fact, online services are e-commerce. The law says that all e-commerce entities must register for VAT. It's very clear in the VAT Act. And so the only practical difficulty with it is how the GRA gets to know that entities like that are providing online services. And this is something that I think that there's a committee currently going on to make sure that there are a lot of, because now people don't do physical shopping. They do most of the thing by online, and the thing is delivered, and sometimes the delivery, if it's a tangible item, is delivered by some kind of courier. If it is an intangible item like educational services, it's done online. We need to be able to find a way of taxing those individuals or entities that are providing online services to other entities. I've had an experience of a particular client that is based that are even non-resident. They are based outside the country and providing online services to customers in Ghana. And the VAT Act requires that they should pay VAT on those services, or they should charge VAT on those services. Though the online entity that is providing a service to customers in Ghana is not by the requirement of the law supposed to register as a company that is resident in Ghana. And so what they have done is basically appoint their representative in Ghana, and then whatever charges that they have charged the customers in Ghana, they submit information relating to that, and then the taxes are calculated in Ghana and paid on their behalf. And so it is important to know that that is an area, an emerging area. The law provides for it already. All that the system will have to do is to be able to ensure that those people or entities engaged in provision of online services pay their due VAT, charge VAT on their customers, and pay the VAT as well.
Thank you, Doc. Richmond is adding a response to the slaughterhouse issue, and he says that sale of local animal is VAT exempt, but not the slaughtering service. So I guess that's his take on the issue.
I agree with him, but what I'm saying is that if the slaughtering forms part of the sale, you see, before I go to the butchers and I decide to buy maybe a goat, and the butcher is the one selling the goat, and sale of local animal, yes, is exempt from, but before I buy, as a condition of buying, I wanted him to slaughter for me. So what about that? Are we saying that because he's going to charge a little bit on top of it, or whether he's going to charge, or it's part of it, he has added it as part of his of his services, or as part of the sale, we should charge VAT on that? I think it's an area that either we expand the law or we just don't disadvantage local industry of butchers. And I think that if it is something that can be, maybe we could be asking for a ruling from the commissioner of the GRA, Commissioner General of GRA, to rule on the fact that whether or not the slaughtering activities should constitute a sale for VAT purposes. It's something that we should explore.
All right, Doc. Thank you. Abdul Karim is asking that if your total tax clearance certificate exceeds your self-assessment liability for the year, will GRA refund the balance or credit your account for the next year?
The practice is to credit your account for it. GRA generally doesn't like paying money back to people. They rather try to keep the credit for you. So it's most likely that the first point will be that GRA would like to keep the credit for you, and so that you can use it subsequent years. However, it is also possible for GRA to refund only when the GRA undertakes an audit to verify all the records of the entity and ensure that confirm that the tax credit is truly a tax credit for that purpose. Then after that, you could actually ask the GRA to refund the money to you by cash, or use it as a credit for future tax payments. And GRA is open to all of that.
Okay, thank you. Kwesi Kunedo is asking, is fees paid to a watchman for share of security service? Does fee paid to a watchman for share of security service attract withholding tax?
Do I understand this question? Fees paid to a watchman.
A watchman for security service, I think.
Okay. I get it now. It depends. What do I say? Why do I say it depends? If the watchman is an employee of the entity, then fees paid to the watchman it will not attract a withholding tax, but it will attract rather a PAYE. However, fees paid to a watchman where the watchman is just is not an employee of the entity, just hired maybe from a company or on his own as an individual, and payment of fees to the person, that one will attract a withholding tax of 7.5%. But if the watchman were engaged as an employee of the entity to take care of the properties, then in that case, the withholding tax, the tax that will apply will be the PAYE graduated tax rate.
All right, thank you. Abdul Karim says, please, how can one file for self-assessment liability? Is one expected to present his or her annual report to GRA?
two things come into play here. When it says self-assessment, it could mean two things. It could mean that the estimate that is made at the beginning of the year, which is supposed to be filed with the GRA by the end of the first quarter, and that the estimate is made for the whole year, but it's filed at the end of the first quarter, and then the liability on it is payable on quarterly basis till the end of the year. That is it. But this estimate, we call it estimate of tax payable, and also call it self-assessment estimate. Mm-hmm. Now, this estimate that just requires the taxpayer looking at its business for the year and estimating what they think that they can pay. That's why we call it self-assessment. This one, GRA doesn't interfere, doesn't involve. And so whatever you file to the GRA is accepted that way. And it's filed, and all the taxes that are paid on account, because the actual results are not yet out. At the end of the year, when the company or the entity decides to has finished basically the tax returns are supposed to be submitted. The tax returns must be completed and filed with the GRA, and based on the actual report, in other words, the actual performance of the company. And the actual performance of the company is only reflected in audited financial statements. And so GRA wants to see evidence of what you actually have done for the whole year in terms of your activities. Then if any tax has been paid before in the course of the year, those taxes are used to reduce the tax liability that should have been paid based on the actual performance. But it's important, and to answer the question, it's important that when the return is being submitted at the end of the year, which is the annual self-assessment return, that return is accompanied with the audited financial statements.
Okay. Thank you very much, Doc. We'll take a few more and then we'll come to a close. Please, is it okay? That's from Gideon Gamelid. Is it okay to pay the VAT on the goods bought instead of withholding and going to pay at the GRA office?
To pay the VAT, I don't get that. Read it again.
Goods purchased instead of withholding and going to pay at the GRA office.
We're talking about two things here.
Okay.
We're talking about withholding tax, which is due when there's a payment for goods bought. Are you with me? So yes. When he's talking about withholding will be triggered when there is payment for goods bought. And that withholding is the obligation of the withholdee with the withholding agent to take the withholding tax and pay to the GRA.
Yeah.
VAT is charged by the person who is supplying the goods. VAT, so in other words, someone is the goods that are being bought, the one who is selling the goods to the buyer charges the VAT. And so the VAT is calculated on the value of the goods. And so the payer would have to ensure that in paying for the value of the goods, they add the amount of VAT that was charged on the goods. So at one point, one person is taking a withholding tax on payment for the goods. At another point, at the opposite side, is the supplier who has a charged VAT, and that the payer would have to include the VAT on payment to the supplier, so that the supplier can also go and account for the VAT. So there are two things that are happening in this particular question. One relates to who has bought the goods. The other is who has sold the goods. The goods that are being bought, the responsibility of the buyer is to make sure that the GRA, they withhold tax on payment of the price for the goods that they have bought. They withhold tax. The one that has sold the goods is required to charge VAT on the goods to the buyer. and the buyer is also supposed to remit money to the seller in respect of the VAT, so that the seller can also go and account for the VAT. One is income tax, the other one is expenditure tax, and so those distinctions must be very clear when in terms of the question the gentleman is asking.
Okay.
Mm.
Audience, we would have loved to ask all your questions, but we are running out of time. And so we'll have to bring the questions to a close at this point. Thank you so much, Dr. Nyami. I know that you would have had the patience to answer all the questions that they have posed. So perhaps we may have to look for another forum on this topic so that you can have a further interaction with our audience. Thank you very much. We appreciate your presentation. So I'll revert to our President Chair to give us his closing remarks after your very exciting presentation. Thank you.
Thank you.
Thank you very much, Abigail, and thank you very much, Dr. Nyami. Indeed, it has been a very insightful presentation. You've handled all the issues that you're supposed to handle. We are very grateful for that insight.
Thank you.
I will not want to repeat whatever has been said, except to just do a quick summary. I put the issues raised by our colleague into a triangle, three main issues that he has raised, with a lot of sub-issues under them. As we walk into 2021, in order for us to be able to grow our businesses within the prevailing tax environment, we all as accountants and other practitioners must have deep knowledge of the relevant tax legislations and all the reliefs provided by these legislations, the incentives, what is allowable and not allowable, what are locational incentives, industry-specific incentives. So we should apprise ourselves of all of that and become current, because that's what will help us to know what to do in order to reduce tax burdens on businesses and ensure that the businesses grow properly. The second key issue is for us to also become very current with respect to current tax measures announced by the government, either in the upcoming 2021 budget that will be read within the first quarter of 2021, or any other special tax measure that will be announced by the government arising from the COVID issues or any other matter that government will want to lessen the burden on businesses. So often as accountants, we take some of those things very lightly. So the presenter's call is that if we need a toolkit in order to be on top of the tax environment and help businesses grow sustainably, then we should all become abreast with all the measures announced in the budget with respect to tax, including incentives, privileges within the tax administration to defer and delay filing and or whatever privileges that are available. We should get to know them and take advantage of them, including post EPIC business recovery packages that have already been announced and may be announced in the upcoming budget. And the last but not least of what he has advised us on is to strictly comply with our knowledge of the law and with the measures that are being announced. Compliance, paying promptly, filing promptly, keeping adequate records, and ensuring that we have reliable records, and also minimize tax avoidance and then harmful tax practice. All these will help in order to keep our businesses sustainable within the tax environment. So there is more to learn, there is more to talk about as far as taxation and sustainable business is concerned. I know when it comes to tax practice, we do more advice to businesses than we do to government, on balance. And the tendency for us accountants is often to advise businesses, to plan and arrange their transactions in order to avoid taxes. It's very legal to avoid taxes, but we also have to be minded that government needs to raise revenue to keep development going, and so we should not we should not engage excessively in excess tax avoidance schemes to the detriment of revenue for the administration. With these few remarks, we will want to thank Dr. Nyami again for an insightful presentation. We will share the slides. They contain very useful tips and bits and pieces of information that can help us stay relevant in 2021 as practicing accountants. I want to thank all of you. I guess we are almost about 171 online, and so the Institute is grateful to all of you, for signing in and staying online to participate in this very lively discussion. And let's continue the debate on the various faculties, particularly the tax faculty. Let's make this matter an enduring discussion. We are yet to have the 2021 budget, and so let's increase our appetite to be very involved when the budget for 2021 comes up for discussion. The Institute will like to take a deep dive into the budget when it is presented, and so we can share our perspectives with the Ministry of Finance. And I will call on the tax faculty to put itself in readiness as we gear towards 2021 to listen to the 2021 budget. So as an institute, we can package our views in a paper, which we shall share with the Ministry of Finance. So I want to thank all of you sincerely for your participation and wish you well in the evening. And I hand over to Abigail to close us with a closing prayer and announcement, if any. Thank you very much, and God bless us all.
Thank you very much, President Chair. And so, our distinguished ladies and gentlemen, we are most grateful that you participated in our virtual public lecture. And on behalf of the council, management, and staff of the Institute, we wish you all best of the season as we go ahead into the Christmas season. And also to remind our members who belong to our district societies and ICAG that our Christmas, Thanksgiving and Christmas Carol service will be held on the 22nd of December. And we hope to see you and listen to you as you sing in grand style. Thank you all, and God bless you. Shall we share in a word of prayer? Our gracious and heavenly Father, we invited you to be part of our public lecture, and by your grace and mercies, it has gone very well and successfully. We thank you that you have watched over us, and we pray that as we get to the close of the year, you continue to surround and protect each and every one of us. We give you praise and we give you glory in Jesus' name. Amen. Thank you all once again, and have a pleasant evening.